see you,
Yes,
but the host still disabled.
yeah, so let
Participant.
me do that right now. So you should be able to share now.
Okay, let me see if I can find. Okay.
So okay, great. So thank you, Mark. I appreciate this. So I'll just let you do the presentation and then we'll talk after. Thank you.
Okay. Then I need to go.
There you go. Very good. Thanks.
So are you at home or at your office so late in the day?
I'm at home actually. Yeah.
Okay, great.
Yeah.
And the others also, I guess.
Yeah, no one's here right now. I'm gonna record it, and we have an event this weekend at my house. I have a separate building here where you came in last year. That was live, but the group on Monday, that was when I had a special group there. But I know you were busy. But I'm gonna show this recording to them.
Okay, so you want me to start now?
Yeah, we'll just start.
And you have some questions later.
Yeah, so we'll do your presentation and we'll do some questions. I have a couple others. Yeah.
Okay, great. So good day, everybody. And I'm very pleased to be with you, although from a distance. I think the world is very complex because when I started to work in 1970 on Wall Street, essentially you paid attention to the rate of inflation and to interest rates and monetary policies and whether the Fed would increase the prime rate or not. And it was very America-centric. Today, the world is very different in the sense that, as I shall explain, we have a new world, and this world consists of rising countries in terms of economic power. Just consider China today makes up for 28% of global industrial production, much larger than the share of the US, which is at about 14%. And China produces more cement than the rest of the world combined. So we have here a huge entity that has emerged and is a very powerful country, economically speaking. And then we also have India, that in the last few years, under the government of Modi, has emerged and is growing very rapidly, but it's still a tiny proportion of the world's economy, but it is larger than Britain. So it's the fifth largest economy in the world already. And still, it is relatively small in terms of per capita consumption and of per capita incomes in the world. So it will continue to grow, in my opinion. And then you have many countries that have close to or more than 200 million people, like Bangladesh, Pakistan, Indonesia, Brazil, and so forth. So this new world, which we call nowadays BRICS and related countries, has become a very powerful force in the world that didn't exist in the 1970s. And the Western influence is not as important as it was during the era of colonialism and imperialism after the Second World War. This ended. And now we have these new countries and they want to have a certain standing in the world. And this inevitably leads to economic tensions and also geopolitical tensions. You can see here, as an example, the share of world consumption of the US and China. In China, it's growing rapidly. And in the US, it's been sort of declining as a percent of the world. It's not declining actually, but as a percentage of the world. And if you look at here, the per capita consumption of different countries, which is in the last column, say the US consumes here annually per capita 934 gallons of oil. China 138. In other words, the US on a per capita basis consumes much more than China. But the interesting part is India, which is the third largest consumer of oil, only has a yearly per capita consumption of 51 gallons. So that inevitably will go up. And so in my view, the consumption of oil will continue to rise. And this is not only my view, but also some experts at Goldman Sachs and so forth. And this will kind of underpin the demand for oil in future. The Chinese economy has been slowing down, and in my view, is at the present time not growing, but probably contracting. Never mind what the government will tell you. A further problem, and this will be an issue in future growth rates, is that the population is now beginning to decline. These are official statistics from the United Nations on various universities, and they all point down to a decline of population over the next, say, 30 to 50 years by about 50%. I have some reservations whether the population will decline by 50%, but it will decline, and that will contain economic growth rates inevitably. And there will be a consistent labor shortage in China, although manufacturing nowadays is more and more produced by robots. But the population will simply not consume as much as its growth rate between, say, 1990 and 2010. The growth rate inevitably will go down, at best, in my opinion, to around 4% per annum. So if you look at the recovery after 2010, it was driven mostly by Chinese economic growth in the world. That, I think, is over. Now, India can take the role of China, but India is so much lower in terms of industrial production in the world that to grow at this rate will be very difficult, and to have an impact on the world, economically speaking, will be next to impossible because they start from a much lower level. The BRICS organization is not politically all that significant, but it is significant in terms of the countries that belong to the BRICS. None of the European countries belongs to BRICS, and the new members you can see at the bottom of this graph: Argentina, Egypt, Ethiopia, Iran, Saudi Arabia, UAE, are not particularly Western friendly, but they occupy geographical locations that are very important, especially South Africa and also Ethiopia. And so this group of countries, and wider seen, the group of emerging economies, is a bloc that is not particularly Western friendly. That the West has to understand. Many of these countries feel that the West is lecturing them about human rights and all sorts of things, partly through the WEF and through WHO and UN. In the view of these countries' population, the UN is a Western-dominated organization and not particularly friendly towards these new rising countries. You can here see the difference between emerging economies and the developed countries. Here in dark blue, you have emerging markets, the developed countries. The market cap of emerging economies is very small, say roughly 20% of world stock market cap. But if you look at the population, you have 88% of the world's population living in this emerging world. And if you look at historians like Durand, they expressed the views that at some point, the wealthy people are losing their power because of the size of the poor people. And I just want to say that the majority of these emerging economies are essentially representative of relatively poor per capita income countries, whereas the developed countries have a very high per capita income, including the US, Australia, New Zealand, Canada, and the whole of Western Europe. But the emerging world has a much lower per capita income, and therefore tensions inevitably arise. Global trade has been contracting for years now, which is an indication that the global economy is not particularly strong. I looked recently at the statistics of Thailand and Hong Kong, with which I'm familiar with. And the fact is, from COVID low to today, the economies have recovered. There's no question about this. But in Thailand, say the economy is still way below the peak in 2018, 2019. And in Hong Kong, as a broad measure of consumption, I take restaurant receipts over the Christmas holidays, now just completed. They were all about down 25% from the peak in 2019. So the Asian economies have recovered, but with few exceptions, like India, the GDP per capita is down, and the economy has not recovered to the trend line growth that they had before 2019, before COVID. So this is an indication that the global economy is not particularly strong. One of the problems I foresee for the Western countries, and I have here statistics about the US, but the same or even more pronounced would apply to Western Europe. If you look at the period of industrialization between, say, 1800 and 1900, it would be down here. Then the government debt hardly grew as a percent of the GDP. In 1910, none of the European countries, nor the US, had government spending at more than 10% of GDP. Now, in most countries in Europe, it's around 50%. Some are at 60%, and some are, like Switzerland, at only 39%. But in the US, we're at a relatively high level. Now you have to understand, when the government grows and grows, it means more bureaucracy. It means more laws. It means more regulation. And that are regulations that make business difficult. So if you compare, say, the period 1800 to 1900 and 1900 to today, between 1800 and 1900, the GDP per capita in America grew at a much faster pace than it's grown in the 20th century and 21st century. This is important to understand because in the 19th century, we had relatively few regulation and we didn't have a central bank because government expenditures, they require a central bank to essentially finance them to keep economic growth still halfway okay. But it's not been as strong as in the 19th century. Now, someone may come and say, well, we have a fairer society today than in the 19th century. I'm not sure about that. I mean, in the 19th century, and even before that, throughout history, governments never locked down the economy, never told people you have to stay at home, and penalized people that didn't get vaccines. So we have so-called democracies, but the bureaucrats, they are autocratic, they are dictatorial, and this never happened before in history, in my view. The public debt in the US is out of control in terms of growth. We're now already at 34 trillion, and it occurred mainly because at some point a few years ago, some economic sophistic theory came up, what they call the modern monetary theory, that debts wouldn't matter because the government could always roll over the debt and the government was different than a household. But the problem is that in these periods of rapid debt growth, you get inflation and you get real hourly wages that are stagnant. They have recovered from the low point in the 1990s, but they're still lower than in, say, 1970. And the Fed has these statistics. A young man at 35 years of age, and I'll talk about this later on once again, he earns less and has less money than his parents 30, 40, 50 years ago in real terms. This is the affordability is a huge problem. And it's not a healthy situation because it leads to wealth inequality. The asset holders, like we, the financial people, we own assets. Our customers own assets. Through money printing, asset prices go up and we benefit. Whereas the masses of people that are workers, the lower middle class, even upper middle class, they don't benefit. There's also a thing about what is GDP and how do you measure it. Normally, people look at gross domestic product, but they fail to look at gross domestic income. I think the gross domestic income is more representative of the typical household, and that has been trending down in recent years. This is a statistic published by the Census Bureau, and I'm mentioning this because recently the Treasury Secretary, Janet Yellen, had the audacity to write an article in the Wall Street Journal, and the article was not fact-checked by the Wall Street Journal, and she's claimed that people today are better off and have $1,000 at the end of the month surpluses, whereas in reality, the median household income has declined by more than $2,000 during the Biden administration. because the cost of living has been going up at a much higher rate than salary increases. Maybe not in the financial sector, but for workers and for people that have small businesses. Contrary to what Ms. Yellen says, if everything was so brilliant in the economy, you wouldn't have all that many people living paycheck to paycheck. Agree strongly. That statistic was published in July at 58%. We now have reached 62%. That tells you something about the economy. The economy is bifurcated. I mean, I was in a restaurant recently in Switzerland, and when I'm in Switzerland, I always go to the best restaurants. And in that restaurant, it was packed full every night. I asked the waiters, who I know personally, because the restaurant is over 100 years old, how is business? They told me never better. This is the economy of the wealthy people. And we belong to that class. We may not see it, but ordinary people, they don't go there. They can't afford it, not even once a month. And their economy is not doing well at all. So this is a very rough survey of what I think is happening in the world. We have artificial growth in the Western countries driven by fiscal deficits. And at the same time, we have the rise of the emerging world in terms of economic and political influence. And that creates huge tensions in the US and other Western nations. In my view, the conditions are such that the fiscal deficits can only be overcome in the long run through taxation, increased taxation. But we are in a presidential election year. Who's going to propose to increase taxation? Nobody will be elected by the people in Europe and in the US who says, look, we have to tighten our belt, we have to cut social security benefits, and we have to increase your taxation. So that is out. The second is repudiation, in other words, default. This is very messy because the whole pension fund system and insurance companies, they own government bonds and so forth. So default is very tough. And the third is the easiest, and every country throughout history has solved inflation, has solved fiscal problems through inflation, starting with Greece and the Romans and so forth. So this is the environment we find ourselves in. It could be that stocks go up because of the fiscal deficit and of money printing. And here we'll have to discuss whether monetary conditions have become tighter or not. And we could have essentially what some people call a silent depression. In other words, I've visited many countries that had very high inflation rates, mostly in Latin America, but also in some Asian countries. You have high inflation and nominally stocks go up, but the currency collapses. And so in real terms, stocks go down. And the per capita incomes of the typical household goes down. The standards of living are going down, but nominally you don't see it. You see it in real terms. I mean, I've seen in Argentina, which is one of the world's largest food producers, I've seen food shortages in the capital, Buenos Aires. Food shortage, because the farmers didn't sell their products to the cities because the products went up in price every day. and the money kept depreciating. So if they sold their produce, their products to the cities, they got money, but that money then collapsed. So nothing happened, and there were shortages. What I'd like to discuss briefly, we have high stock valuations in the US in selected sectors, mostly high tech. The valuations are as extreme as in year 2000 during the dot-com bubble. And we have valuations that are very low in other sectors of the US stock market and in Europe, and especially in emerging economies. So the big question is, if the FANG and FANG-related stocks, or the so-called Magnificent 7, or there may be Magnificent 15 stocks, if these stocks go down, will they drag down the entire market? Or is it possible that these overvalued sectors or highly priced sectors decline and the money flows into other sectors of the market? I'm mentioning this because, say, after 1980, oil stocks and energy-related stocks in 1980 made up for approximately 32% of the S&P. So after 1980, when the oil price stabilized and no longer went up, and after 85, the oil price collapsed, the oil stocks began to decline after 1980, but the money flowed into other stocks, and so the entire market went up. Same for Japan, and I know this very well because I thought at the time that Japan, which had in 1989 a market cap of 50% of the world's stock market cap, I thought that if Japan would collapse, the rest of the world would also go down in terms of stock prices. But no, Japan collapsed, and the US, especially tech stocks in the US that were very cheap in the early 1990s, went ballistic, and other emerging markets went up strongly. So you can have both. You can have the leading sectors going down and pulling down the entire market, but you can also have the leading sectors going down and the rest of the market goes up. This is an issue. But relatively speaking, I would underweight US stocks. I would buy emerging and European stocks and properties and infrastructure, rural and resort properties in emerging economies. And then I would belong some commodities, and I would be negative about bonds long term. Now I will explain this very briefly. In my view, we have turned up in the inflation cycle, and during war times, commodity prices tend to go up and also inflation to accelerate. Now, we may not have a World War III, but I have very well-informed and educated American friends, young people, that believe that the US wants World War III. It's not necessarily my view, but looking at the expansion of the conflicts in the world, we have countless conflicts all over the world. And I think this environment will lead to more inflation in the long run and not less. Having said that, I fully agree that after having this huge inflation push between, say, 2019 and 2022, the rate of price increase has slowed down. and some prices have come down, like selected agricultural commodities. Oil have come down from the peak, but the price level is still 25% higher than, say, pre-COVID. So the Fed can then say, yeah, well, we brought inflation down. But the reality is that the price level is still much higher than, say, 3 years ago. And you should know it yourself, because you also have a wife that bitches about the price increases at the department stores and grocery shops every day. This is the example of the 10-year Treasury yield in the 70s, okay? This is important to understand. The first peak of inflation occurred in 69. And after 69, the rate of inflation came down, and also the bond yield from the 10-year Treasury from 9% to 3%. And then we had the next push of inflation to a peak in 74, whereby bonds then went to over 12% in 74. But inflation wasn't as high as it's been in the last year in 2022. But then after that, inflation slowed down and interest rates collapsed by 50%. And then we went ballistic to the peak in 1980-81. Now, the period of the 70s was characterized, here you can see 69 to 1980, through mostly negative real interest rates. In my view, the interest rates on the 10-year Treasury went to 5%. But in my view, at 5%, we still had negative real interest rates because the cost of living increases were higher. And now we're back to around 4%. So we had a sharp decline in interest rates. In my view, is not justified. I think interest rates over the next 20 years will go up substantially. This is not to say that they can decline to maybe 3% over the next 6 months, possible, because the global economy is, as I said, weak, and the US economy is much weaker than the statistics would show. I'd like to point out that in an environment of money printing, everything is distorted very badly. And if you're interested, there's a very good book about inflation. It's the Economics of Inflation, written by an Italian who was working at the Reichsbank in the period 1918 to 24 during the hyperinflation time. So here is the title, Bresciano Turoni, The Economics of Inflation. This explains everything what happens during inflationary times, what stock prices do, what the foreign exchange market does, what gold does, what wages do, and the impact of inflation on society and on wealth concentration. During inflationary times, there's a huge wealth concentration. And this is the Bible for inflation. So if you're interested in the subject, I strongly recommend you to read that book, because in inflationary countries, stocks can become very inexpensive. One example, in 2021, I recommended and I invested in Turkish stocks. And all my Turkish readers, they sent me emails and said, how are you crazy? You know, the country's bad and so forth. But at that time, the currency depreciation had exceeded the rise in stock prices. So in real terms, stocks were very cheap. And in 2022, the Turkish fund went up by more than 100%. And in real terms, in dollar terms, Turkish stocks went up more than 100%. And today you can go to Turkey, and this is very important to understand. If you walk around Istanbul, you will not notice anything special. And they have an inflation rate of 100%, but everything is indexed. So the absolute level of interest rates in Turkey, they are around 100%. The absolute level of interest rates does not tell you whether monetary policies are tight or expansionary. And in my view, the US has increased interest rates, the cost of money, but there's still plenty of liquidity around, and monetary conditions have actually in November, December eased considerably. This is also the view of other economists, of notably Goldman Sachs, that monetary conditions are expansionary at the present time and inflationary, I'd like to add to this. So this is the treasury yield. The question is, do we go straight up? I don't believe so. I think we will, well, we've gone down dramatically. The bond market rally in November and December was the strongest 2 months bond market rally since 1982. In other words, 82 is here, up here. This was a strong bond market rally. And here we have it as well. So I believe that interest rates will not go down much more in the near term. But because of my negative view about the global economy and the US economy, and because of an election year, and the Fed doesn't like Trump, this is obvious, they'll probably ease monetary conditions further for another 6 months. And then we'll go into the next inflationary cycle and next cycle of interest rates. This figure I want to show you that inflation cycles and interest rate cycles are very long-term cycles. They last maybe 25 years, 30 years from the trough to the peak, and then from the peak to the trough, again, 30, 40 years, and again, up again. But it's very difficult to bring down inflation in the current environment because the fiscal deficit is not going to be solved overnight. In my view, the fiscal deficit will actually rather increase than decrease. One of the problems the US faces, and this is a real problem at the present time, is the rapid increase in interest payments on the government debt. We are now, this is an outdated chart, but we're now close or over $1 trillion interest expense on the government debt. And this will go up. Also in Japan, they can't increase interest rates, or they don't want to, because if they increase interest rates, the interest payments on the government debt goes ballistic. So in my view, given the fiscal deficit and given the large government debt that already exists and the interest payments that are going up inevitably, what can the government do? They can default, increase taxation in an election year, no option. The only option and the least painful in the immediate future is to print money. And I think it's going to happen in the next 12 months. Investment-wise, commodity prices are very low relative to the S&P. You can see it's essentially at an all-time low, going back to the 1970s. Also, real assets, commodities, real estate, collectibles, precious metals, also very depressed compared to financial assets. Now, some real estate, we have to distinguish. Real estate in major cities like London, Frankfurt, Madrid, Milan, Zurich, Geneva, New York, and the major cities in America, Houston, Dallas, Seattle, San Francisco, they are high, but real estate in the countryside is low. That's where I would buy a house, in the countryside, not in the major cities, because the major cities are vulnerable to declines. And the second point I want to make about real estate and about inflation, the viciousness of inflation is that when you print money, not all prices go up like this. What happens is prices go up here, then they go up here, and so forth. So when people say, well, I own assets and they've gone down during an inflationary period, this can happen. And it happened in commercial real estate in the US. Commercial real estate in San Francisco, Los Angeles is down approximately. I've seen buildings that were sold at 45% of the price in 2014. I've seen good buildings, modern buildings, sold at 48% discount to the price that were paid in 2018. Huge discounts. So this can happen for stocks, it can happen for bonds, it can happen for anything that prices go down. The price of Rolex watches have also gone down in an inflationary environment. So this is inflation. You never know exactly where is the next push upwards. And this is a challenge for the fund manager. But in general, I would say that financial assets relative to real assets are relatively high, and the indices are high, but individual stocks are not necessarily high. That you can see yourself in the US. The Russell 2000 is a different story than the S&P and the NASDAQ. So I would go for the depressed sectors. One of the sectors that I think is depressed still is the energy sector. It's gone up a little bit, but not much. Say, compared to the peak in 1980 or in 2009, the energy sector is very low as a percent of the S&P. And I think that if I measure, say, everything in gold, I measure the S&P in gold and other commodities in gold, then oil is much cheaper than gold. I'm a large gold holder, but not because I expect gold to go up a lot, but for the safety aspect of gold as an insurance against financial assets. This is the reason I hold gold. Then we have to discuss, how do you hold gold and where? Do you hold gold in the US, Canada, Australia? Or do you own gold in Hong Kong, Singapore, Dubai, Russia, China? So these are issues that are important for someone who has wealth, who is a wealthy individual, or for a fund. Emerging markets at the present time have never been as low as they are presently, except in 2003, after the dot-com bubble burst the market, and they were very cheap in 2003. They're very low at the present time, and I would have an above average weighting in emerging economies. I'll discuss briefly afterwards in what sort of economies. You can see the US has outperformed Europe and the rest of the world enormously. And I have to say enormously. The US stock market is more than 50% of world stock market capitalization, whereby the US population is not even 5% of the world's population. So I think this will be corrected the way Japan was corrected after 1990. The dollar enjoyed a huge boom until recently. It started to decline until October 22. Then, it peaked out in October 22, then it declined. Recently, it's been sort of rebounding. But I think the trend of the dollar long-term is down. Now, I accept the view that for such and such reason, the US dollar will still be the leading currency. But I think as a percent of global trade, more and more countries will hold reserves in other countries than the US. It's a central bank issue, it's a political issue. Many countries don't feel particularly safe to have large dollar reserves, and more trade between China and other nations is carried out in local currencies or yuan and not in dollars. I'd like to also highlight a correlation which is very interesting. Here you have the trade-weighted dollar is the green dark light, US trade-weighted dollar, but it's inverted. So in other words, here, between 2003 to 2007, the dollar was weak. And after that, it strengthened until recently. The red line is global stocks ex-US, okay? So during periods of dollar strength, here is because the dark line here is inverted. During periods of US dollar strength, emerging markets or global stocks perform poorly. They perform well during US dollar weakness, which was here after 2003 to 2007. And after 2009, 2010, global stocks grossly underperformed the US. So I think if the dollar weakens, in other words, this goes up here, this dark line, then the prospect for emerging economies and European markets improve. And 2023, we had actually some European markets that outperformed the US, including Italy and Spain. And in Latin America, we had many markets that outperformed the US. Also, Iraq outperformed the US, strangely. And so I think the case I want to make is that you should have an above average exposure to emerging economies. One sector that is very depressed, I'm not saying gold is particularly cheap here. If I compare the cost of living in the 1950s, what say a croissant cost in 1955, and what the gold price was at the time, $35 an ounce, and what the gold price is today, I think that gold is an instrument to maintain your purchasing power. Let's say if we all went to sleep after a heavy night, a night of heavy drug use or alcohol, and we all slept for 10 years, I think an ounce will maintain its purchasing power, but it may not go up. Stocks are probably the better avenue to make money, but we have to find sectors that are depressed. Now, gold miners, compared to the S&P, are very depressed, and they are also depressed relatively to, the gold price. If we look at the gold price, sometimes gold miners sell at a premium to the gold price. At the present time, they are at a discount. There's another point I'd like to emphasize here is, it's amazing to me that after a gigantic housing bubble in 2007, we have superimposed another gigantic bubble in home prices in the US. And as a result of that, young people are faced with an affordability issue. I want to tell you, when I started to work in 1970 for White Weldon Company, it was an American investment bank that was then bought by Merrill Lynch. After my training, I went to Zurich for 1 year and I rented an apartment. It was 2 rooms and a large kitchen and a large bathroom with a cellar and an attic for 7% of my then income. 7%. Best location, behind the Stadttheater. This is the opera house of Zurich. It's not a grand opera house like Vienna or Milan, but it's an opera house in the best location of Zurich. And nowadays, please find me anyone who lives in the center of the city who doesn't spend 30 to 50% of his income on an apartment. The GS is not my invention. This is Goldman Sachs. Housing affordability index is at an all-time low. Young people today have to struggle. They need the support of their parents. The parents have to buy them a condo or give them some allowances to afford them a decent life. This is the reality. Now, one sector that I think among emerging economies and global markets that is cheap are Latin American stocks. They're depressed. Some of them have gone up already in 2023 strongly, more than the S&P, but from extremely depressed levels. So this is say Brazilian equities, they've gone up, but they're still very depressed compared to other markets. And one reason I like Latin America, relates to geopolitical issues. If you look at where is the next war going to happen, Ukraine will likely be solved through negotiations. The Middle East, the conflict in Gaza, I'm not sure that negotiations can take place. I think it's very difficult to find a peace solution that would meet the expectations of other Middle Eastern countries and the whole world. Don't forget, the world at large has a very different impression of the war in Gaza than the Western Alliance, Western Europe, and the US. It's perceived very differently. So I don't think there is an easy solution there, and it will increase the cost of doing business and probably of commodity prices, including the oil price. Brazilian equities, they correlate with commodity prices, but at the present time, they've been depressed compared to commodity price. So I think this is an option. Argentina is also relatively low, especially after the recent devaluation. My favorite market was Peru, but the stock market has also gone up. And I still like Colombia. It's a major agricultural producer, as we all know. And the country is doing very well, and the stock market is very depressed. And there's some good companies in Colombia. The last point I want to make is we will have selected inflationary pressures. In 2023, we had a huge increase in the price of cocoa. In other words, the price of chocolates has gone up. And in Asia, we had a huge increase in the price of rice. Now, I'm not expecting the price of rice to go up much more, but it has increased the cost of living of the majority of lower class Asians. I mean, for me, it doesn't matter whether the price of rice goes up or not, because it's not my staple food. Although I eat rice, I don't eat as much as poor people do as a percent of their food content. And so I think the inflationary pressures in Asia will probably accelerate. Finally, I just want to close my remarks with some observations. I believe, having been involved in emerging markets, that emerging markets are not as cheap as they were in the early 1980s, and they're not as cheap as they were in 2003, 2004, and they're not as cheap as they were in 2009. But compared to other markets, they're very inexpensive. And if you want really an unusual situation, if you consider that the media is very positive with the FANG stocks, the analyst's favorite stock for 2024 is NVIDIA. The opposite is the Hong Kong and Chinese stock market. The media in the Western world only writes negative about China and Hong Kong. And I've had 2 articles recently that were published in Hong Kong. And this is the first time I've seen this, that in Hong Kong, local journalists, of course, they're paid by American NGOs, but they published 2 very negative articles about the property market. I agree, property prices in Hong Kong will probably go lower, but I'd like to highlight that Hong Kong property companies have a low leverage. Some property companies in Hong Kong, large ones, among the largest, have 0 debt, 0. And the families that control these companies usually don't have a high leverage because they made so much money, they didn't need to borrow money to build the homes and sell them. The cash flow was very high. So these companies, I give you an example. Hong Kong Land is selling at 25% of asset value. Now, let's assume the asset value drops another 30%. I don't think it dropped another 30%, but it can drop another 20% after it dropped already 20%. But at 25% of book value or asset value, the stock can probably rise as property prices continue to go down, because the stock market is a discounting mechanism. And other property stocks have actually started to perform better in the market. Recently, the Hong Kong stock market has been weak, but property stocks have stabilized. And then you can buy conglomerates, say Jardine, the Jardines Group. It sells also at a huge discount and is not leveraged. Equally, the Swire Pacific Group, the Swire Group, is selling at discounts. So you buy actually quality assets. And of course, Hong Kong's character is changing. Hong Kong was a very free city. It's still very free relative to other countries. And it's still incredibly efficient. The infrastructure is superb. I can guarantee you, if you're in Hong Kong, near the central district, even beyond the central district, in half an hour, you're at the airport. That I can guarantee you. If everything goes well and there's no traffic, you're there in 20, 25 minutes. Where in the world or in the US can you be at the airport in New York City? Can you be at the airport in Kennedy in rush hours in less than 2 hours? So the place is very efficient still. And I have to say this, the student demonstrations, and I know this well because I was the trustee of the children of the leader of the demonstrations, Jimmy Lai, who sits in jail, is now in court. He's been in jail for 3 years. So I know Jimmy very well. I know the whole family well. My wife's best friend is the #1 wife of Jimmy Lai. And he was financed by the US without any question. That everybody knows. And the demonstrations were essentially to embarrass China. And after the demonstrations and after the Chinese woke up that some NGOs from the US want to have a political influence in Hong Kong and in China, they only after that did they introduce tougher security laws. But you as an individual, if I'm in Hong Kong, I feel very free, no problem. It's not like in a controlled state. I've been to controlled states, socialist states, and all of you should fight left-wing politicians. We'll have volatility this year. As you can see, the Russell 2000 made a new low in late October, and within 48 days, we made a new high for the year. It's never happened before. And we have still a lot of speculation because there's plenty of liquidity around. We have geopolitical and social tensions. And I think there is increasing the risk of expropriation. So for you personally, for your clients, never mind. But for you personally, I would diversify my assets. But a diversification is not to own Brazilian stocks by a custodian in New York or by a bank in the US. You should have accounts overseas. So thank you very much for your attention. And you, David, if you have any questions, please go ahead.
Yeah, let me just stop the share. That was great, Mark. Thank you. Very good information. Stuff I haven't heard you. I've heard some of that stuff, but that was some really great detail. I appreciate that. I do have some questions. In Hong Kong, I mean, a lot of people don't like Hong Kong because the threat of war and losing your assets, even if you buy, if you have a custodian in New York or you buy an Interactive Brokers, you buy Hong Kong stocks. You're not as concerned about this, I sense. And obviously, because of all the negative news, the prices are cheap, as you noted. So they are very attractive. I first, I think, learned that from some of your writings, and I started looking at them myself. But how do you feel about that? Like, do you feel safe with those stocks over the next 5 and 10 years?
This is my main concern about investing in financial assets throughout the world. War would be a disaster. But in war times, you'd be better off in stocks than in bonds. But where the war will occur, the war theater, in my view, will not occur in Latin America, but it will occur somewhere between Western Europe and Russia. And the second war zone, war theater, could be Middle East. And the third could be, of course, China. Now, there are serious concerns in the Western media about war with China. But I tell you, in Asia, people are not terribly concerned. And in Asia, it's completely accepted. Hong Kong was never a democracy under the British. The British, when they left Hong Kong, they wanted to stuff China with introducing a democracy in Hong Kong. The Chinese system has some sort of democracy, the way Singapore had it for 30 years or 40 years, is a one-party system. Within the Communist Party, there are 100 million members, or 110 million. The people at the top are the people that are the most capable ones. So there's some sort of system. But it's obviously not a democracy in the Western sense, but it's a system where I've seen, because my friend, he runs an Asian fund, and he has more than 50% of his money in China now. Before he didn't have, but in the last 2-3 years, he increased the allocation to China. Among others, he owns the Yangtze River Dam Company, Yangtze Power.
Yeah.
And I've seen this, that they could build a world-class dam in 2 years. I mean, incredible. They go and build something. And also, I was director of Ivanhoe Mines, and we went to Mongolia. The first time we were in the Gobi Desert, there was nothing. I mean, it's a desert, nothing. In winter, around minus 40 degrees, and in summer, huge heat. Within 2 or 3 years, they had built the whole city, and the mine. It's incredible at the speed at which Chinese construction companies can build stuff. I've never seen this in the Western world. I mean, I'm Swiss. We have very difficult infrastructure conditions because of the mountains and the rivers and the valleys and so forth. But in Switzerland, when you go to these building sites, half the time they're empty. Nobody's doing anything. In China, they do it 24 hours a day. They have 3 shifts.
Yeah.
Don't ask me about the human rights aspect of these labor camps, but
Yeah, I understand. So, so let me ask you a question. What do you think about, I know the stocks that you mentioned, the FANGs, a lot of them trade at very expensive 1%, maybe free cash flow yield. But what do you think about companies that can use AI, like the AI plays to increase productivity? Couldn't productivity go up a lot where earnings go up for many companies that not use the AI, not just producing the AI, like NVIDIA producing the chips, but companies that use it? And have you thought about this? Because that can keep earnings up, right? If you can cut 10% of your staff, even if you have a slowing economy. How do you feel about that? Is that a wrong thesis? Does it have some merit?
My view about this that I don't know. It's like the internet. I mean, the internet, say I watch a lot of YouTube. I studied history at school and geography and so forth. But on the YouTube, I can get the whole history of Rome in details in audio video form. I mean, it's unbelievable. So someone who lives in the middle of nowhere in Africa or in India or in Russia or wherever, he could learn and be as cultured as we are. I can listen entire concerts of Karajan and Maria Callas on YouTube. I mean, it's an incredible source of knowledge. But how many people use the internet for knowledge, and how many people use it to waste their time?
Sure.
So it could go, for some people, it will be very good, artificial intelligence and some companies, but not for others.
Yeah.
But I understand your point.
Yeah.
Earnings may stay. Inflation, money printing also, in general, for a while, boosts corporate profits. Yeah. In the 70s, it didn't happen much except for oil companies and energy companies. They had rising profits, and mining companies. But the rest got squeezed by rising labor costs. Could happen.
Yeah. And
I mean, the government just increased wages now by 5.5%. You think inflation is going to go down much more than that? I'm not sure.
Yeah. And speaking of debt, if the US government is increasingly borrowing to just make the debt payments, this can spiral at some point. what is the solution? I mean, you alluded to it, like they would just print more to keep making the debt, and then, but that can accelerate just
Yes, it will.
automatically. And then what happens? What is the end game of that?
Yeah. The end game is written in this book that I showed you, The Economics of Inflation. They
Okay.
then need to have a reform, you understand, a restructuring. And then there is a crisis, the so-called stabilization crisis. It's very painful initially, but then it clears the system. But by then, most people are bankrupted. They have
Yeah.
nothing left.
So you have to own assets, right? I mean, obviously, if you own cash in that scenario, you're wiped out. So, and as you noted, you don't know
You're
which
right.
one.
You have to own assets.
You have to own assets, and you're not sure which.
Except the question is where. You know, the Germans, the rich people, they made a lot of money during that time because they played the foreign exchange market. And they had assets in the US and in Britain and so forth. So they could shift money overseas during phases of rapid depreciation. Then they can shift the money back into assets in Germany and buy stuff at very low valuations.
Right. So your thesis into that point is emerging markets are very cheap, and that's so you'd rather own cheap things as sort of protection too, I assume, because you're not sure what would happen, and if you have things at very cheap prices, I mean, how much more could it go down? Is that, I mean, is that so? And with this scenario of spiraling debt, do you have like, is that inevitable? Is it, what's the timeline? I know you own.
Sorry, the timeline I can't tell you.
But you have any? I know you can't tell me, but if like,
But I think it will accelerate. I think it's not 20 years from here. I
not
think it
20,
will be next 5 years.
next
And
5 years.
talking about buying depressed assets, I was laughing because the first stocks I bought towards the end of my studies, I thought I'd take a gamble. If I doubled my money, I'd travel for a year around the world. And if I lose it all, I go and work. So I lost it all because I bought Penn Central
Okay.
after it had declined 90%, but then it went bankrupt. And I bought Lytton also after it had declined by 80%. And it went down. I remember I bought it at $12. It went down to $1.50. At the low in 74, Lockheed had a market capitalization of $30 million at the low. 30 million.
Wow.
Argentina at the low during the hyperinflation in the 80s had a low market cap of about 600 million. The whole country, 600 million US.
Wow. These, a lot of people sit around now and they're holding the treasuries and they're saying, well, I'm getting 5% at 3-6 month treasuries. I'll just wait for a crash. I like, this is not, I wonder what you think about that, but I hear that quite often. I have people who have a lot of money actually, and they do that. And they're just saying, well, I'm making, on $10 million, I'm making 500 grand a year. I'm going to wait for the crash. When everybody's waiting for the crash, it really happens like that as well, too. Right. So what do you think about that? What would you tell those people?
Well, I also have cash deposits, but when I grew up, my grandparents, they were very conservative people. They never borrowed a penny in their lives. And I also never borrowed any money in my life. But they said, you have to save 10% of your income every month and put it in the Kantonalbank. These are the banks of states in Switzerland. In Switzerland, we don't call them states, we call them canton. And the banks are kind of sort of government banks or government controlled. They also got into trouble in the 1990s, but they are very safe. And nowadays, my view would be for the next 12 months, I put money on deposit for 12 months a while ago at 5.5%, 6%. But the risk of money in deposits is very high, in my view. You understand? I feel safer owning the shares. As this is described in this book very well, that deposits is probably the worst investment in the inflationary environment I envision. Now, I accept that some people could say, well, the economy will be so weak in the world that there will be a demand deficiency. But this is precisely when the central banks print the most money, when there's a demand deficiency. And the fiscal deficit then expands, and you get precisely into the spiral you were talking about. That the debt goes up, the interest payments go up, and so forth.
So,
But I agree with you. I would, with my view of the world, that we are already in recession, I should be theoretically in government bonds. But I think that the government bond yield, the 10 years treasury at 4%, is no bargain at all.
No.
Then I can find stocks that have a bigger potential, in my view. They have actually in Asia. I can find many stocks with a 7% dividend yield.
Yes, it's true. And you used to talk about Singapore REITs a lot. And obviously all the real estate stocks had problems. How do you feel about Singapore now?
Look, the Singapore economy is gonna grow maximum at 2-3% per annum. Maximum. It's just like Switzerland, no growth. But it's very stable. And it's a controlled democracy and a system that functions. They don't take refugees and so forth. So it's very safe. You can park your Ferrari or your Bentley and nobody will scratch it. Try to park your Ferrari or Bentley in Switzerland, someone will come and scratch it. Nobody will break into your house. I used to stay with a very good friend of mine. He passed away in the meantime, but he was one of the wealthiest families in Singapore, and he had a house in Queen Mary area, Queen Astrid Park, best location. The house was always open. The gate to the house always open, and the car keys in the cars. My house, my office in Thailand is also always open. I have a key for my office, but I don't know where it is. I lost it. So it's always open.
You keep any of your gold in there, Mark? No one will tell me.
That I won't tell you. You might be tempted to come and visit me.
I think
no, I have valuable books because I have first edition of Economies and so forth. You can see
very
all
nice
the stuff. But the Thais don't know the value of a first edition of Adam Smith or of Diderot and so forth. So I don't know whether you can see it on the other side.
That's your office in Thailand? I always see you.
Yes. And I have this communist memorabilia collection. All the communist leaders in the world.
Wow.
The one on the left is Sun Yat-sen, and the one on the right is Mao Zedong. Anyway.
And why do you have those? I'm just curious. Do you just interested in the history, or I don't think?
Yes, I mean, when I came to Hong Kong, because in Switzerland, I noticed that old posters had gone up a lot in value. And in those days, when I arrived in Hong Kong in 1973, Mao was still alive. He passed away, I think, 76. And they produced all these badges, the buttons that you can see here on the wall, basically.
Yeah.
And then first I only bought posters. And I bought around 3,000 posters. And when he died, I actually bought the whole inventory of some shops, because my view was after his death, they wouldn't produce this garbage anymore. And then I thought, it's a pity I only have the posters. So I had an employee and I sent him to China and we bought the badges. These are buttons that you put on here. And I bought 330,000. They all packed by my staff at the time in my office. I had to pack them in bags, plastic bags. And then I bought busts and paintings and then I bought the literature of the communist leaders like Marx and Trotsky and Lenin and so forth.
So it's a bit of an investment in a way for you.
Yes, but it's not an investment that in my lifetime will ever be liquid. I'm not going to sell it.
Yeah.
What my daughter will do with it, I don't give a shit, because I won't see it anymore. Or I hope I don't see her life after me.
Yeah.
We don't want to see the lives of our children.
Well, one last thing, if you had, so you alluded to before, like if I couldn't do anything for 10 years, I feel good owning gold. But as you noted, it would probably maintain your purchasing power, but you wouldn't make a lot of money. Do you know the theory of, I think that's what you said, but do you know the theory, the fourth turning, Neil Howe?
Yes.
Yeah, so he talks about we're in that right now, maybe the next 5 years, as you noted too, a lot of disruptive things happen. I mean, you used to say like I own 20% stocks, 24% real estate, 20% bonds, cash. Is that still like if you had to own a portfolio of things now and you wanted to live and survive and hopefully thrive through very disruptive times, how would that portfolio look like? What would you, I mean, diversified across geographies?
I think this may not be an encouraging observation for fund managers, but I think all of us, asset holders, will lose money. Say you have 100 million, you'll end up maybe, if you're lucky, with 60 million. And the dumb people or the people that buy things at the top of popularity, they lose 80% or 100%, the speculators. But say, if the price level in the world in this fourth phase of the cycle goes down by 50%, okay? The price level. We have commodity prices collapsing and real estate prices, and our assets only go down by 30%. We have become richer than if the price level goes up by 100% and we only make 80% profit on our assets.
Yeah.
You understand? We measure in real terms. So I'm saying, if I had to go to jail for 10 years, I can't do any transactions, I think that the gold price may very well be lower than it is today, possible. But other things will be much lower. You see, the people that invested in SPACs, the people that invested in unicorns and in meme stocks, they lost a fortune. Believe me, a fortune.
Yeah. 80, 90% or all of it.
Yes. And the same people were the ones that bought cannabis stocks the year before in 2017, 18.
Exactly.
Tilray and Kronos and all this weed.
Yeah, I know. I talk about that actually. It's because it was a big hype and a story, and it was going to be legal. And these stories often don't end up,
Yes.
but very hard to make happen. First of all, you had to change the law.
I just like to say, I think in gold, you see, my theories, if things really go bad, we may not have a war with front lines like in World War One. In World War One, at the Somme battle, 30,000 people lost their lives in one day. In one day. You have to see this.
Yeah.
An unbelievable amount. And that I don't think will happen. But I think what could happen, and some Modi, he switched off the internet in Kashmir for a while. You know, you can switch off the electricity quite easily. That is modern warfare. You can poison the water. You can switch off the water. You can switch off the electricity. Now you're in New York City, in a big city, and suddenly you have no internet access. Try to go shopping in a shop and pay with a credit card. Not going to work. Try to pay with Bitcoins. It's not going to work. But what will work, hopefully, is, you have small coins, say 1, 2 grams. And then you can, this is I don't know what it is, 5 baht in Thailand. They have different measures, but this is like 2 grams. So you need small denominations. This is 1 baht.
Yeah.
This is worth roughly 1,000 US. So this you need, for investment, you need kilobars in a safe. But for survival, you need this, or in every prison camp, in every crisis situation, packs of cigarettes become money. Yes.
Very interesting. That's just
And there are books about the economics of prison camps, how the price of cigarettes fluctuates, because the cigarettes come in, say, once a month into the prison camp. So then there is a glut of cigarettes and the price is low. But towards the end of the month, the money supply tightens in cigarettes because some people smoke. They don't keep it like a box of sardines just to trade and never eat. So at the end of the month, the price of the pack of cigarettes, which is the money, goes up a lot.
Wow. Interesting. Well, hopefully we don't get that bad. But wait, can I ask you one last question? What are you positive about?
What you're positive?
What are you
as I said, I'm relatively positive about the Asian markets. I'm relatively positive about emerging markets, especially Latin America, Colombia.
Yeah.
And I've never been very bullish about Hong Kong, except when Hong Kong collapsed, like in 82 and after the dot-com bubble. At the present time, I think that the market has over-discounted the negatives. And I'd just like to say, last year, the best performing Chinese stocks were the stocks that were sanctioned by the American State Department. And to you and your colleagues, I would recommend to watch some videos about the technology Huawei has developed. They have much more modern technology than, say, Apple.
Interesting. The Hong Kong market October went down. It was at the same level as 1997, or approximately. And it started to inch back down. And then it went up about almost 50%. And then it's come back down. I think it's in the 16,000s. It's still.
Yes.
So do you think it makes new lows, or it's relatively cheap? I think last October was at like a 9 PE, which was kind of like the US in 1982.
I have a bearish view of the world, so it's possible, but I think that Asian stocks at the current level will go down less than, say, the popular Magnificent Seven in the next 2 years.
Oh. Okay.
In other words, emerging markets and Hong Kong will outperform the US. That would be my view.
Okay.
And I would rather have some weighting in oil. I think oil is not very expensive.
Yeah.
It's expensive compared to what it was when it was -0 in 2020.
Right.
Yes.
That was
And
crazy.
it's more expensive than it was, say, in 1999 when it was at $12. That was the low point for gold and commodities in general. But it is still relatively low.
Yeah.
And this whole ESG nonsense and environmentalism and so forth will use enormous quantity of fossil fuel to build all this stuff.
Yes.
The windmills is a fantasy. It's like Cervantes, Don Quixote. It's a fantasy. It will never work efficiently.
Yeah, it's true.
This inflation we have today is partly fiscal deficits, a monetary inflation phenomenon, and socialist policies that are not leading to productivity improvement. They're leading to inefficient investments.
Yeah.
I think also the whole battery car is a write-off in the long run. There will be new technologies.
Yeah. I think you might be right. It's certainly interesting times. They're cutting supply and increasing the demand. All right,
Anyway,
Marc, thank you very much.
Thank you very much, all of you.
I appreciate
And I wish you all a healthy, this is the most important in your life, the health, good health, mentally and physically, and also a prosperous year, relatively speaking.
Thank you. Thank you, and you as well. So
Okay.
we'll see you
Thank
again
you,
soon.
David.
Thank you. Bye-bye.
Take care. Thanks a lot.